line here from Freedmont Mortgage. Hi. We
Hi,
have Beth
how are
Wood
you?
from
Hi, Beth.
Freedmont Mortgage with us.
Thank you for having me here.
Yeah,
Thank you.
absolutely.
Trying to figure out, or just, have conversations with the industry and know what's going on and keeping abreast and all the other good stuff. So, what exciting things do you have to tell us at this moment, Beth?
Well, and that's the funny thing because really it's changing almost daily, sometimes more than daily. So it's just kind of difficult to say on a continuous basis, but hey, Fezzik!
It was his birthday yesterday.
Yeah.
Oh, happy
6.
birthday. So yeah, I mean, we are just trying to keep on top of it. Everything's as everything changes, as the government, the Govy loans, make their changes and update their policies. The major thing that I wanted to share and why everything's so volatile and why everything's changing so much is that, the Fed came out and said that people should be able to have forbearance on their current mortgages, if they're having trouble, which is great, to be able to help people out if they're suffering from all of this and not being, so many people are losing their jobs, so many people are furloughed or laid off, and maybe they'll have their jobs when they get back, but right
most
now,
of them will.
Yeah. So there's just all that unsure uncertainty. And so, the Fed came out and said everybody can forbear their loans if they need to, and we'll make that process easier. The problem, and one of the reasons that everything became so volatile because of that, is that the servicers still have to make those payments to the government loans. So especially Ginnie, which is FHA. So that's great. The borrower does not need to make those payments, but the servicer still does. Well, now the servicer might have thousands or millions of loans that they're servicing that could possibly now go into forbearance that they now have to make payments to Ginnie on. So now they're trying to hedge their bets basically and say, okay, on one side, we've got all these loans that we may now need to make payments for the next couple of months on. Maybe Ginnie will loosen up. Fannie and Freddie did, and are saying, okay, well, you don't need to make those payments either. They opened their credit window to allow that to be a little bit easier on the servicers. But Ginnie hasn't yet. So, if we're now on the hook for all of these payments, that's going to reduce the amount of money we have available for future loans. Mm-hmm. Then you also, that's one concern, problem, thing that might be happening. Then you also have loans that are in process, people that are trying to buy, people that are trying to refinance, and they may not have income in the next couple of months. So how do they make their payments on these new mortgages that they're making and having? So, basically people being the servicers, the lenders, are realizing all of these different scenarios that could possibly happen, and how do we try to mitigate these problems as much as possible, not knowing what's going to happen tomorrow, with what the government might say, pardon me, with what might happen, when we might get back to work, all of these things. So that's what's basically causing so much fluctuation, so many changes on a daily basis. Every time somebody comes out with, a new idea, a new thought on how to help the general public, it creates a storm in the background of how do we make sure that we're still able to manage this and
well, there's so much misinformation going out around. You've got everybody just going not deferment, but you were saying what? Forbearance. Yay!
Yeah.
Not realizing that you guys, as the lenders, the servicers, don't actually have a forbearance, and that seems kind of short-sighted of the government, in my opinion, to do that. And then me personally, I'd rather have a deferment than a forbearance, right? Have it put on at the end, as opposed to one lump sum. I think we're just asking for some major issues when it comes to the forbearance, because it could be 3-4 months, and who the hell I mean, the majority of the country, they say, didn't have $1,000 in their bank before this started.
Right.
How the hell are they going to have 4,000, 5,000, 3,000 to suddenly give one payment on?
Right.
So what happens then? Do you guys, do the servicers, not you, but the people that own the loans, then start foreclosing on thousands of properties?
Right. Which we already know from 2008 is the last thing the servicers want to do.
Right.
It's not the best option to try to start foreclosing on all those properties. That they're servicers of loans. They want to just run that money through. They don't want to own property.
Right.
So, and then trying to get rid of that property and all the other things that go along with that. So it's not the ideal for anybody. So I think everybody's, we're all just trying to figure it out. Everybody's just trying to do the best you can to stay afloat. So it's kind of funny, lenders, businesses, and people, we're all kind of in the same boat. We're all just trying to figure out how to manage our finances as best we can, stay afloat, and still be here in 2 months.
And, we're obviously central Pennsylvania based. We're here in PA. We've been shut down now for about,
3 weeks.
3 weeks with 3 more weeks to go. You, being Freedmont, are in a unique position where not only do you service Pennsylvania, but you do Maryland, Virginia, West Virginia. Am I missing anything?
Yeah, we're pretty much the whole East Coast, all the way down to Florida, actually. The majority of our loans are in the middle East Coast, Pennsylvania, Delaware, Maryland, Virginia, North Carolina.
So what
primary stretch.
Is this a common theme throughout all those states, or?
It really pretty much is. There are slight differences with how much restriction you guys have versus how much maybe the Maryland agents have. They are still allowed to go into properties, and there's restrictions on them, but they are still able to go in.
That'd be nice.
To show properties. I know you had some loosening recently this week on, other businesses that can go into the property now. Inspectors can go in, appraisers can go in.
That's only if the contract was signed
prior to.
March
6th, when we had the National Declaration of Emergency.
Which I kind of think is bullshit, because we were allowed to continue to work for another 2 weeks prior to that. So
right.
What does that say about, and that also brings up an interesting thing about what about contracts that are being written now sight unseen,
that's right. Well, I have questions more about, so.
I'm sorry, I'm going on a tangent.
It's not about you, it's about Freedmont. So I know a lot of people, I've heard a lot of ruckus about, the government-backed loans. So, it's your government-backed loans that you can reach out, and that CARES Act said, hey, people have the option of forbearance. As just a general person that doesn't know a whole bunch about stuff, well, what about conventional loans? I mean, is that being affected by this at all? Are they tied up into this? If I have a conventional loan and I suddenly lost my job, what should I do, if anything?
So really, that's going to be across the board, whether it's conventional or whether it's a Govy loan. So what all the servicers are looking at, what all the investors are looking at, which an investor just means Fannie, Freddie, anybody who's, either backing
off
the loan
yeah.
At the end. Yeah. So they are, like I said, considering the fact that people might not have income, or very much money, and, you're going to feed yourself before you're going to pay your bills. You're going to do those things that you have to do first. So that might mean some people start going behind on their mortgages, or, that's not the first place they're trying to put their money. So that is why you're seeing tightening of guidelines. That is why you're seeing, some lenders and saying, we're going to raise the minimum score. We're going to raise the minimum debt to income ratio. Pretty much across the board, that's happening. Everybody's just kind of squeezing that a little bit to make sure that the borrowers that they do have, that they do continue to run through, are in the best position possible to make it through. A lot of the loans are now with 2 months reserves that, we wouldn't have looked at reserves a couple of months ago. We didn't care about reserves. We didn't need reserves because that just
You
wasn't.
assume that there'd be money coming in if you had a job.
So you're at a 2-month reserve right now then?
We can do them without 2 months reserves, but that's one thing, is that we're a lender, so we can make some case by case decisions. If we feel like, say we're doing the loan on the wife only, but we do know that there's a husband, and we do know that he has income as well. So maybe we make a case by case decision that they don't need the 2 months reserves. But ideally, these are the things that everybody's looking for now, is just a little bit cleaner of a loan, just to make sure that there's as few buybacks as possible. Everything else is tightening up so much, and there's less and less money available to, when these loans are sitting on the pipeline longer before we can sell them off, that means there's less money available to make a new loan.
Yeah.
So
and then if someone's not paying that as well, while we have it sitting on our warehouse line, then that's just even less money that we have available. So everything's basically, you got to look at that warehouse line and go, okay, I only have, $1 million. There's way more than that, but let's say we only have $1 million, and you have two $500,000 loans, and your $1 million is all gone.
Right. And then just for clarification, when you're saying reserves, what you're meaning is that the borrower needs to have that amount saved in their bank account that could cover that loan payment for 1-2 months or whatever that is.
It doesn't need to be liquid, so it doesn't need to be sitting in their bank account, but it needs to be available. So yeah, I mean, it could be in some sort of investment or something like that, but something that it would be liquefiable.
Right.
So if it's in stocks or something that could be sold, of course, what are those worth now? But if it doesn't have to be in the bank account where you go to the bank and write a check, it can be something that's a little bit more of a difficulty to get to, but it would be something that you would need to be able to get to if,
like a couple hundred rolls of toilet paper, that would work.
If you can prove that you sold them.
I know, that's shitty.
Are these changes affecting people that, let's say hypothetically, I got a pre-qualification, the world turned to shit and went upside down, and I was at a lower credit score, and now my lender is saying, oh, are these changes affecting me? Is anyone grandfathered in, or is everyone like, well, these are the new rules, adjust?
Yes and no. So, again, ideally we're trying to get to those new parameters as best as possible. So if someone's score was, 645 and now it's 650, we can probably get their score raised. So maybe we're going to just work with you and get your scores to that new 650 mark. If it was, 620 and now we need to be 650, can we get you there? Can we not? Are there other compensating factors that go, maybe if you've got 6 months reserves, that makes it a different story than if you've got no reserves.
Right.
So it really becomes kind of just more of what are the compensating factors? What can we make this look like it makes sense?
Income ratios.
So if I'm understanding correctly, it sounds like, okay, on the one hand, the industry, the mortgage industry is just trying to make it so there's stronger, cleaner buyers with having, a different debt to income ratio, a higher credit score and stuff like that. But at the same time, if you were caught in the middle of this web, everyone's realizing that the playing field is changing hourly, and maybe it would be in their best interest to talk to somebody, not just assume that they're out.
Right. Yeah, for sure. Because, worst case scenario, what we're doing is if they're not qualifying and there's nothing we can do, the least we can do, what we can do at that point is just go, okay, let's just keep everything on hold. And then as soon as the rate hits, that's going to make your debt ratio what it needs to be, or as soon as this loosens up, or as soon as you're back to work, or, whatever the issue is, then we can jump right on it and move forward. But if you're just sitting in the background going, nothing's going to work for me, then once everything does ease up, you're at starting point one, and you're way behind all those other people. And I really think that once this breaks loose, lenders are going to be really jammed.
Yeah.
Yeah.
So, you know, what you think, oh, well, I'm back to work now, let's start. And this was normally a 30-day process, might become a 60 or a 90-day process, just because, you know, there's only so many people that can process this file. And,
Wow.
you know,
So I hadn't even thought
they can
about
only do so many loans a day, and there's only so many people that can do them. So
I hadn't even thought about that, because before this happened, typically it was 30 if you were rushing it, 45 on an average contract. Should we be looking at like 60-day closes once this actually breaks free instead of the typical 45?
we could be.
Okay.
We could be. I don't know. We're not asking for that now.
Right.
But I mean, even now we are asking for a longer contract, you know, or if on a refi, you know, a refi should be an easy 30 days, but we're looking at more than that. We're looking at 45 to 60 days on refis, because it's taking longer just to get the loan processed. You know, if I'm trying to call your job to verify employment and nobody's there, how am I supposed to get a verification of employment? So, you know, every document is taking longer. The title companies are taking longer to be able to access title work and get it back to us.
Shut down.
Right, right. So everything's taking a little bit longer to process as well right now. Once it eases up, will there be a backlog? You know, these are just things that we don't know right now, but I think that if you are interested at all in possibly refinancing or buying, you should get into the process now anyway. Even if you do have to get to a certain point and then just sit on hold, at least you're already to that point.
Well, that's kind of what we're telling our pipeline is like, hey, now's a great time to start figuring out what you want to do, pick the houses you want to see, and then let's go out and hit them in earnest when we actually can.
Right.
I know there's virtual showings being allowed, and people are writing contracts sight unseen, but that just scares the hell out of me.
Yeah.
Right?
No, I mean, we've had a couple of sight unseens close. So they bought it, never seen it in person. You know, they see it on the.
And, you know, some of those are military or that need to move. And I've found military that move often. They're more likely to do that because they know they're only going to be there for 3 or 4 years. And if they hate it, who the hell cares? Right.
Yeah.
What is your minimum credit score right now for like an FHA loan?
I do believe it's 660.
660?
Yeah.
Okay, because you threw out 650 there a couple.
I think I did. I think I meant 660 though. I'm sorry.
But still,
it's
okay,
raised up though. Is the point?
It's definitely much. Yeah, it's higher than
I mean, it's still lower than some out there, so that's a good thing for you guys. Hey.
Yay.
And then I also think the program, the promo you Freedmont and us have going is a fantastic thing right now.
Right. Yeah, absolutely.
Many
so
people
you know,
are going to need that.
For sure, being able to possibly get your mortgage paid for a year is definitely going to help at the end of all of this. So,
right. So.
Yeah. We do, you know, like I said, everything's changing on a daily basis. So we have actually talked to a couple of lenders or investors that we haven't worked with in the past that may be able to loosen us back down to like 624.
Nice.
It's just, you know, we like to really vet a couple of loans through a new investor before we just go closing loans with them, just to make sure we understand the process, that we have control of the process. Because the last thing we want is unforeseen issues stopping us midway and just causing disruption for everybody, you know, delays for the buyer, and then that looks bad on you and on us. And, you know, so we're not really putting those out there yet, because even though we want to be able to offer that product, if it falls apart, then it's not really a real product. So
right.
As we go through this and things tighten up, we'll also find avenues, hopefully, to loosen them back up again as well. And so who knows what I'll have to say next week. We might have that product online, so then we'll be back down to 620.
Definitely let us know if that's the case.
Oh, absolutely.
Again, we've spoken to one lender and they're at 680 for an FHA, which is, whoa.
Yeah.
680, 50 debt ratio, and 2 months reserves, probably something along that.
I think they're 1 month, but that's on all their loans at this moment.
Right.
even the
Yeah.
conventionals. So they're just like everybody has
Yeah.
to have a reserve.
Right. So that's probably our compensation. We're 660, but 2 months reserve. So
Right.
like I said, everybody's just trying to find a way to keep things as normal as possible, but also to make sure that at the end of this, they still have money to lend.
Oh, that's awesome. Yeah, this is weird times, but we definitely appreciate your expertise and kind of clarifying some stuff because we don't know what's going on.
Right. Yeah.
Yes, we do.
No, we don't.
That's why there's two of us to help everybody through, right? And that's why we have title companies, because I don't know what they do. So, they do their thing and they do it well, and we do our thing and we do it well, and you do your thing and you do it well. So together we make the team that gets everything done well.
But